Thanks for having me, and thank you for your interest in Target Healthcare REIT. It's good to see such a busy room here this evening. I did think I'd be from the most exotic location this evening, coming from Dunblane or Stirling, where our business is based, but I think the Isle of Man trumps that, so I'm disappointed to see that, but thank you guys. I have a hot tap and a kettle in my house as well. You don't need to see that, so I'll tell you a bit about Target Healthcare REIT, what we do, why we do it, how we do it, and some of why I think that is interesting, and hopefully you'll agree with that. It's a simple business. We're a real estate investment trust. We're a property company. We own property, we collect rent, and we pay shareholders a dividend. Fundamentally, that's what we do. We do that by owning care homes in the UK. We have 94 homes that constitutes over, or just less than 6,500 beds for our residents. We have almost 60 million of contracted rent, 900-ish million of portfolio value. And we do that letting the buildings to a diverse range of 34 different tenants to give us diversity of income. We're not relying on one tenant. There are no real big care home groups in the UK. It's quite a fragmented market. There are lots of operators out there. We have lots of tenants mirroring that, and we think that's the best way to go about it. We're IPO'd in 2013. We've been going for just over 11 years now, and we're a FTSE 250 company. So that's great. We're a property company. What makes us different? What's interesting about it? Well, in my view, we only invest in modern, purpose-built care homes. Like that picture you see there, which I think is in Dartford, but I might be wrong. I'll double check. Purpose-built means wide corridors, means lots of social space, means outdoor space, and means wet rooms, which I'll talk a lot about, and we do talk a lot about, and we make no apology for that. Our portfolio is all like this. And more specifically within that, we are practically 100% wet rooms. So what ensuite wet rooms mean is that every room for every resident has an ensuite private bathroom, tiled floor, drains away, they have a shower. Sadly, and pretty poorly, 67% of beds in the UK in care homes do not have that facility. There's 450,000 care home beds in the UK, 67% do not have that. Many of them purport to be en suite, but that is largely often a WC and a wash hand basin in the room. It's not even a private bathroom, never mind an ensuite wet room. 100% of ours do, and we think that's very important for care for the resident, for the social impact and looking after residents. It's 2024. When was the last time any of us in here paid for a hotel room without an ensuite private shower and chose not to go to a shared bathroom? We think that's very, very important for residents in care homes in the UK and should be market standard. We're also, with the modernity comes the sustainability and the EPC. So all of our homes are either A or B EPC rated. Again, we think that's very important. There's a lot of talk about upcoming legislation such that commercial real estate has to be B or above rated, or else it is not allowed to be let to tenants. So ours are already there. A lot of UK commercial property has a challenge when it comes to meeting those standards, and will have, remedial capex, which will be needed in order for those buildings to be viable over the longer term. We don't have that in the same way that much of UK real estate does do. And with that modernity comes long leases. So our leases are typically 30 or 35 years, and we have 26 years remaining on the ones we have in the portfolio. And with that comes guaranteed rental uplifts, so that what is common in the sector is inflation-linked leases. The rent goes up every year, linked to inflation and with collars and caps. So minimum 1.5% income uplift we get every year, up to a maximum of about 4% based on the caps which are on those leases. So guaranteed rental income coming through, increasing every year, and that compounds year on year in a sector which is able to afford it for reasons we will show later on. What does that deliver? So in terms of returns, I'll just focus on a couple here. These are the results from our most recent financial year end. I think the key thing is, as mentioned, is the dividend. So we'll be paying 5.7 pence a share, roughly a 7% yield, depending on where the share price is, fully covered by cash earnings. And the accounting total return in the last year was just about 12%. Property values are staying up, holding up, because it's an in-demand sector. We're growing earnings with that growing rental income, and that's supporting the total returns. So Really, really good performance for us in the wider commercial real estate sector, which has been struggling a little bit since the summer of 2022 and the trust quartering budget and the change in interest rate environment. Another point of evidence about our consistency and performance is our comparison of our portfolio returns with the benchmark. So the benchmark here is the MSCI UK Healthcare Property. It's an 8 billion, I think, value of benchmark. It covers GP surgeries, care homes, hospitals, that type of, those types of real estate. We were the number one performer in that benchmark for the year, calendar year 2023, and we're the second best performer in the 10-year period up to 2023 as well. So really good, stable, long-term, consistent performance from what we think is a quality portfolio. And why do we think the outlook for our portfolio and our company is positive? A couple of fundamentals within the market. If my slides will click. We've got two I'm going to talk to. One is fairly obvious. It's the demographic change which we're going through as a nation. We're an aging demographic. The number of over 85s today is projected to double by 2050, and it is the over 85s who are primarily the residents in care homes across the UK. And then secondary, that's the demand side, so lots of demand coming through. There's demand presently. I will dwell on this slide. So the supply side of care homes, and I've talked about quality already, is very important. So the 3 bars here, the green is the real estate which is modern, purpose-built within the last 10, 14 years. I'm sorry, my keys dropped off the bottom of that slide there. The red is the older converted real estate, so old Victorian B&Bs, that sort of thing. Narrow corridors, no social space, small rooms, no ensuite private shower rooms for the residents. The orange bits are the ones in between, and they're typically they're purpose-built, but they don't have private ensuite wet rooms for people. The bar on the right is the 450,000 care home beds across the UK. So I mentioned 67% of those not having an ensuite wet room. You can see that the quality of the real estate within the sector is, in our view, very poor and not suitable and not appropriate for 2024. Our company is on the left-hand side. Our portfolio, as I say, it's all modern, it's all purpose-built, it has wet rooms. And then you have access as investors to care homes in the UK through other listed property companies. The standard of their real estate is quite mixed. So there's one UK-based company and there's a European-based company with a large portfolio in the UK. They have a lot of the older, poorer, non-wet room stock. And we are far happier now and for the outlook into the future being in the modern, purpose-built stuff. One, there's a clear commercial advantage in our view. If you have a choice, you have the funds, would you not rather put your loved one into a nice modern home with the social space, with the wet rooms, et cetera, et cetera? Secondarily, we believe it's the right thing to do. From a social impact point of view, we feel as though the estate needs to be modernised, and we're helping advocate for that and invest in new homes, new buildings. One more quick point on that, against commercially. The type of real estate, so commercial real estate has been depressed over the last 2 years. The concern across investment in property is that shares are trading at discounts to book value because investors don't believe book value. We have sold 8% of the portfolio within the last 2 years, and we've achieved that at book value or above for all of those properties. So there is a market for what we invest in. It's in demand by institutional investors. It's in demand by tenant operators to be owner-occupied, and we're able to realise book value when we choose to do so to improve the portfolio overall. So that's the real estate. I think there's probably some interest in our tenants and how they're performing, because real estate without any rent isn't really worth anything. Our portfolio, our tenants' profitability as measured by rent cover, so basically their earnings or their profits divided by the rent. We underwrite our assets when we go into an initial investment expecting that that will come to a ratio of 1.6 times. So if we don't think it can meet that, we won't be investing in it, and obviously we'd prefer more. The portfolio has been delivering 2 times rent cover over the last 12 months, and spot as well. So our tenants are profitable, they're doing well, and it supports the quality of our rental stream and our ability to convert that into a dividend for shareholders. And I think it would hopefully be insightful to you guys to show you a bit more about that trading and what our tenants across our portfolio are achieving. So the top row there is the average weekly fee that residents are paying and how that has increased over the last 5 years. And as you can see, at 13%, 10% has been ahead of inflation. The private pay percentage, so that's the percentage of residents in the homes who are privately funded, as opposed to local authority funded. So relying on their own funds, not relying on the government or local authorities. That has increased across our portfolio from 66% to 74%. We believe as a virtue of the quality of the real estate and the ability of our tenant operators to attract those residents who are able to pay fees commensurate with the services being delivered. That's a very important point because our tenants in difficult environments, there's lots of headlines in the press these days about how care home and the social care sector is generally going to struggle. Our tenants have been able to increase their private pay percentage as a number of residents, the proportion of residents who are paying privately, and increase the fees from them to cover their increasing costs. So from general inflation since COVID, from minimum wage, from NI, all that sort of stuff, our tenants are able to vary their top line by increasing their fees, and that helps support their profitability and their ability to pay our rent. I will just flag the biggest single line item on a care home operator's P&L after revenue is staff costs. It's generally around 50-55% of their revenue. They are, as I say, the ability to manage that and manage that well and pass on any inflationary increases to their residents helps support their bottom line. So the private pay is important. Their ability to generate or increase their fee income is also very important. And I would add, for those who'd be concerned about that rising and rising and rising, the average length of stay in a care home by a resident is 18 months. So most residents will typically go in, they will experience one inflationary fee increase during their length of stay. Not every day, of course, but this is the average. And generally, if that's tangible and linked to visible cost increases, residents will accept that and their families will accept that, and it's able to be passed on. So tenants are profitable, despite what you may hear in the sector. So that's real estate. That's a bit about the tenant profitability and the importance of private fees. I am an accountant, so I'm going to have to show you some financials, but I won't dwell on them, don't worry. It's another photo of one of our real estate. Again, very simplified. This is the company P&L. We have roughly 60 million of rental income coming in. We've got operating costs of about 10 million, and we've got debt financing costs of about 10 million because we do have debt on the balance sheet and we are geared. And that equates to roughly a 40 million cash profit. In the REIT model, we are obliged to pay all that out as dividends or distributions to shareholders. And so that is what we pay out as dividends. So we believe it's a fairly efficient property model, converting that rental stream to dividends to residents. Shareholders, sorry. We are lowly geared. We've got LTV or gearing on the balance sheet of just over 22%. We have 320 million of total debt facilities, of which 150 million are with Phoenix and tucked away into the 2030s. The two bank facilities we have are up for refinance next year. Everything is hedged to November 25 at the moment on pretty good rates. And I'm currently, engaged with those two banks about refinancing at this point in time as well. Not going to be an issue. They're very supportive. It's a very conservative gearing level and debt level we have, and it's well secured by the properties with absolutely no challenges to the covenants. So we will refinance next year. The increased debt costs we will incur at that point are already well factored into our forecasting and our dividend outlook and everything we've been doing over the last 2 years. So it's very much factored in and baked into our forecasts. The dividend should continue to increase, all being well. It's not a profit forecast, but as our rental income increases, the earnings will increase. We know where the debt costs are going to be or very closely, and we can see that dividend being progressive over the coming years. And then this may or may not be interesting, but we thought a lot of focus on gearing within property companies in a moment and the use of debt, and we've seen debt can be popular, it can be very unpopular. This correlation of the earnings yield and LTV against property companies is one that we thought might be useful to show. You want to be in the top left-hand quadrant there to show that your gearing or your debt is actually being accretive and working for you to help increase your earnings without taking on any undue risk. And we expected to see us in the top left there, but it's nice to have it confirmed that our gearing is working for us even at those conservatively low levels. And that was me. I I have lots of other slides in the appendices, which you will probably receive by email afterwards, but I thought keep it brief, keep it punchy, and try to give some insight into what we are and what we do. So thank you for your time.
Any questions in the room at all, please? This gentleman at the back, Steve.
Hello, thanks for the presentation. You mentioned management fees there. So how independent is the management company from the PLC that we would be investing in?
Yeah, so we're externally managed, as you point out. We have an IMA, which guides what we can do, the scope of our services and how we are remunerated for that. There is an independent board of directors, 5 experienced directors in London who hold us to account. So in terms of corporate governance, we're clearly just flag, we're FTSE 250, main market, premium listed. We abide by the various corporate governance structures which we need to do to be part of that. We're a chapter, the listing rules have changed, but we're chapter 15 investment company. So again, all the corporate governance that we need to abide by, we are doing so.
Thank you.
This gentleman here, Steve, please. Thank you.
Thank you very much for the presentation. I am a shareholder, but your dividend took a hit a couple of years ago, didn't it?
Yes.
Can you expand on, is that getting better? Or?
Yeah, so we took the decision to reduce the dividend following, I guess, what we saw at the time and what we saw as being long-term was a change in the interest rate environment. So Finance 101, gilts went from 1% to 4%. One might have expected the income yield we receive and how our investments are priced to move from 5.5% to 6, 7, 8%. They did not because of the demand for the property in the sector. So those yields and valuations held up. It meant we weren't able to get that spread anymore on the cost of debt or the cost of funding versus the income yield that we would have expected to have achieved potentially on the asset. So we were always targeting a higher dividend based on a sensibly conservative gearing level, which did give us that bit of a boost to our earnings. That just wasn't going to be achieved with the change in interest rate environment. So we took the decision early to rebase the dividend and then started growing again from that point, which we have been able to do over the last 18 months.
Okay. This gentleman here.
Just a quick question. What are your current occupancy rates? And if a tenant wasn't able to continue, are there penalty clauses? I'm coming from the point that I think 26% of your clients are currently local health authority-based clients. And if there was a cut due to difficult decisions that Keir Starmer has to take, if you only got 74% occupancy, what sort of hit would you take?
Sure. Okay. Good. Gives me an opportunity to explain. So the property company, all of our properties are leased to tenants. So we have 100% occupancy at property level to tenants. Our tenants then have the split of their own, the residents who are paying them or their clients, which is the 74%, 26% funded by private and local authority. And those tenants, the bedrooms and the care homes at the moment are about 87% occupied. So I talked about we underwrite our investments in the 1.6 times rent cover. That's typically derived from our tenants having 90% occupancy at the care home level, no matter who that's funded by. So it's running a bit below that, having been down very low post-COVID. And what we found, interestingly, is that our tenants are sitting at that 87% occupancy with inquiries and with waiting lists, but they're quite happily profitable. And they're kind of happy sitting at that 87, 88% level rather than pushing up to 90, 95, 90, and beyond. A care home really is never going to get much beyond 90, 91% occupancy naturally because, unfortunately, people are dying and there's turnover and new people have to wait to come in and be assessed by social care, et cetera, et cetera. So our tenants have the ability to increase occupancy and have more residents there. I guess the political side of if a local authority goes under, who's guaranteeing that resident being paid? Again, there is a legal obligation on the local authority to pay for a resident's care needs or social care needs where that resident needs them and can't fund them themselves. We've seen, 2, 3, 4 local authorities go bankrupt recently, and those residents have continued to be funded and be paid for by central government funding, pooling, etc. So it's, from what we've seen, the money keeps coming in, the residents are funded and paid for, and the care homes are receiving the revenue for those residents who they're caring for.
Interesting. Yeah. Thank you.
Again, thank you for the presentation. Dividends are a nice thing to have, and you've got a reasonable history with that, and I understand your rebasing. But overall, I'm interested in the total return rather than just the dividend.
Mm-hmm.
And if I'd invested with you 5 years ago, my value would have gone down by 25%. There seems to be a disconnect there, I have to say, insofar as it, with the quality of presentation and the way you laid it forward, it appears to be a good and robust business model. But the market doesn't seem to be recognising it, and arguably the market's always right. Perhaps you could comment on that.
Well, the market is always right. If I was to if I was to suggest the market was wrong, I would upset many people. I think property world, net asset value or NAV has historically been how they've been. Companies have been valued and how investors value it, and whether they're able to say whether they're happier with that or not. So it's based on the property value. We are able to achieve the values that we have in our balance sheet. We've sold 8% of the portfolio over the last 18 months, and that has occurred. The value is there. I think at the moment, investors are taking stock, the listed markets are taking stock at what the dividend is relative to where interest rates are going to settle and whether they're happy with that spread or not. And interest rates seem to be settling, but the forecast is for them to go down, which should hopefully help our rating. We think I would also argue that perhaps the market just doesn't believe that our property values are robust. You know, there's the modernity, there's the EPC. I don't think that's necessarily reflected well in how some people are valuing our properties. Our hope is that our properties and the long-term demand, the quality of the rental stream that we have will be recognised in due course by the market. I think fundamentally we're just a small part of a wider property market and a wider equity market. And I think when people are selling and when they're not allocating funds to property because it's out of vogue, that doesn't help companies like us. And we would expect and hope that the quality that we have will come through in the end and will be fairly rated. But I have no guarantee of that happening, but that's what we'd hope.
Thank you.
Okay. Yes, please, Steve. Young Tim. Thank you.
Thank you. If you had if an irresistible opportunity came your way to either build a dozen new care homes or, say, acquire a competitor, can I ask you how you would propose to fund that? Often investment trusts, when they expand, will issue new shares, but if you're trading at a big discount, you cannot do that.
Yeah. So we're a property company. We want, and we're on a mission to improve care. We want to be building new homes and supporting the build of new homes, but it has to be commercially viable for others and then for us to do that. Clearly, if the cost of debt does decrease and there's a spread on the return that we can achieve from the homes, we will be able to do that, but we don't want to take the gearing up too high. I think there's an argument in the listed markets and property companies specifically that if you can prove that you can make an earnings accretive investment using equity, perhaps issued at a discount, not necessarily the full 20-25%, but say 10% of your issued share capital will be earnings accretive, then there are indications that investors would support that. Yeah. So we're looking at...
New investors might support that, but I wonder if existing investors would.
Yeah, I mean, nobody likes to be diluted, but I think there is an acceptance that with the persistent discounts the sector overall is seeing, that if earnings are improved via it, they may accept the dilution. But again, that's what we're hearing from certain investors, what others will disagree.
Thank you.
Thank you. Anybody else? The gentleman over there. Yeah.
Yes. I wonder if you ever thought about eventual introduction of artificial intelligence to reduce cost of staff, so implement.
Yeah, so within our business or at the homes?
Yeah.
Within our...
Well, it could be both.
Yeah.
So it's up to you to think about.
Yes, we have somebody working within our team in Sterling at the moment looking at AI and how it can help us as a business. I think extending that to care homes and people and residents who need people to look after them and care is a very different thing. But within our own business, we're looking at it.
Thank you.
Okay, the gentleman here.
What's the breakdown between developed properties and acquired properties? In other words, how many of your properties do you develop from scratch? You know, buy the land, build, design the property, commission the building, and how much do you acquire?
Yeah. So our model, being very conservative, is we have helped fund the development of a number of properties, I'd say probably 20, 25 within our portfolio, but we always do that. There's no planning risk. The site is already acquired by somebody, the planning is in position, and we will do it on a pre-let basis so that somebody steps into that property on a lease, operating the property from day one once it's completed. So as I say, we don't speculatively acquire land and look to build care homes. It's something we're looking at, but we haven't had to do that over the last few years to get pipeline and develop.
So it's largely off the shelf properties?
Yeah, it's with existing tenants of ours who are looking to grow their business, or developers we know, or other people within the market who will come to us as a funder and a long-term holder of those properties and say, oh, we've got this, we're thinking we'll get planning permission, do you want to get involved and help us with the design and then find a tenant? We will be proactive in doing that to make the opportunity ours, but we are not taking that initial day one risk on the site.
Okay, thank you.
Thank you. So you do have influence on the makeup of the care home?
Yeah, we're always keen to get in early, and as I say, the design and the amenities within the home are very important to us. Yeah. We've got some great examples over the years of, first floor social room, dining room with windows being too high for someone in a wheelchair to see out of. So we've always had that kind of influence on the design of home. Simple things that we know. Our team has lots of experience of running homes and caring for people and seeing what happens and what really happens in a care home day to day, and applying that to the real estate and the design of the real estate is something that we've been able to do as well. Yeah,
because you see, old homes and, very old homes.
Yes.
And they're very, very bad in terms of the facilities, aren't they? To have that influence over going forward is brilliant. Yeah.
Sorry, I probably should have looked at your slide earlier, but can you tell me about your geographic location? Where are you focused?
Yeah, across the UK. We have no bias towards any particular regions. Obviously, we wouldn't want to get overweight in any particular regions, but for us, it's all about the 10-minute drive time of the home. Is there demand for the services from residents with appropriate wealth in that area? Is there a supply of staff to look after those residents in that area? The 10-minute drive time is very important because nobody wants to have to drive 45 minutes an hour every day to go visit a loved one for half an hour and what can be a difficult visit sometimes, and then drive home. So it's all about that local drive time and whether the home can operate well from a care point of view, be staffed, have low turnover of staff, and basically does the local market support that home there? We're relatively agnostic as to where we are in the UK, but equally we'll construct our portfolio in sensible and not be overweight in any particular region.
Okay.
Make sense?
Just a quick one.
Yeah.
Oh, sorry. Sorry for coming back, but it seems like it's almost too good to be true. You've come first, and et cetera, et cetera. Why then did you sell 8% of your portfolio? Normally, companies try to grow rather than shrink.
Yeah, we want the portfolio to be as good as it could be. So the most recent sales we made at the end of June this year were 4 of our oldest properties with the shortest lease lengths remaining, and sort of some of the lower metre square per resident. Some of the smaller properties. They're still great properties, they're still modern purpose built, but we saw an opportunity to sell them for good value and put the funds towards some new homes which we've been building out, some of our developments, just so that the portfolio is as good as it can be, effectively. Churning it, tightening it up. Yeah.
Okay, we've got time for one more question. Any more questions coming from the floor? That's it.
How many different care home operators do you have? Is that varied, or do you have one major?
34.
34.
Across 94 homes. we actively want to be diversified and not rely on big groups or one tenant in particular. And more work for us, but we'd rather do it that way.
And who are your major shareholders?
It's largely wealth managers based, but as you'd expect, it's BlackRock, it's Premier, it's Investec, it's CCLA. They're very active in asking us questions, as you can imagine, based on their outlook and their way of investing. So,
got plenty of room for retail.
Yes.
Yeah, always. Okay, thanks very much.
Thank you.
Great presentation. Thanks, Gordon. Thank you.